Bring in a guest who knows an awful lot about these things. Phillip Streible is Chief Market Strategist at Blue Line Futures, often trading at the CME. So I wanted to start with just exactly what you were thinking today as this price went, because it really did. You know, we often talk about catching a falling knife. It felt like that as we watched the price of West Texas get to historic low. It breached $10. That was a headline. It breached $5, and many of us said, wow, I haven't seen that in my lifetime. And then here it is, a negative. What were you thinking as you watched it fall?
Well, it was definitely an eye-opener once we broke $10, and then we started to move lower from that. And, you know, working at the CME, we did get notification that the CME group allowed that contract to go negative, and that was a new release that just came out today. And once you see that kind of notification, you know, I mean, from my days working with coming into these tight delivery situations, you know, oftentimes risk departments are contacting to find out the other side of who the you know, the person with the contract is. If they can't get a hold of them, you know, that contract's going to trade all the way up until the end. And for every seller, there's got to be a buyer. And once they allowed that contract to go negative, it looked like they couldn't get a hold of the buyer. And I'm almost to think that perhaps the buyer of that contract could be unavailable. Who knows? They might have gone bust in this entire move, and there's just no one there. So it's going to be settled, and it'll end up being a credit situation.
So, as we did, there was some talk in the marketplace today about a big hedge fund in Asia that may have gotten offside. It has that whiff to you that it may have been too late for somebody at some point, and they just don't have the capital to respond?
That's exactly what I was thinking. It could be that specific hedge fund there. I'm not saying that it is. I'm just saying that you know, when you see those kind of headlines like that, you got to think that, you know, perhaps maybe they were on the other side of this thing. So, you know, it goes down, we end up trading negative, and they're going to be penalized by that. You know, it's the opposite when the market goes limit up for days and days. You know, we've had pork belly contracts, you know, all kinds of different commodities that go limit up for several consecutive days, and where you see there's no offers in there, so the market just goes limit bid. And this was almost like a limit down situation, just the opposite.
So just in terms of what might happen next, we're quite aware, and we keep sort of reminding to the point, and you're making a key point here, which is not only are we talking about the May contract expires tomorrow, was thinly traded relative to June. June was the contract where the action was happening today, and June is still above $21. What do you think? So added to all of that is the fact that maybe May is owned by somebody who's bankrupt. So it may be a super technical issue here. What do you think happens with June when June is the only contract available? Does 21 feel like the right price, in other words?
Yeah, June's definitely, I mean, that's the active contract. That's the real reflection of the price of crude oil. May is just an anomaly that's out there. I do believe, though, that June's it's not going to face the same caliber of problems, but definitely there is a competitive you know, bid for people trying to get oil in storage. And if you run out of storage, then oil prices seem to come down as the market's flooded with the product. So I do believe that oil prices are probably going to travel in the teens for the June contract. I don't know if a situation like what we saw today, I mean, I can only imagine that's a, you know, once in a lifetime type event. So I don't see oil prices going negative again. Not to say that they can't, but I definitely think that prices, you know, the supply-demand imbalance, unless the economy all of a sudden makes some dramatic turnaround and the floodgates are open. I mean, first, I drove into the office today. That was the first time I've moved my car in months. So, you know, I mean, I can only imagine everyone else. There's no demand.
Well, we were just showing the contracts, the sort of the contango that's evident in the contract. We just talked to Mike McGlone at Bloomberg, who's saying, you know, what you're seeing in May is the pricing in of macro realities that say there's a global depression coming, and that has shown up in other asset prices already, like negative yielding bonds. It has yet to show up in stocks. When we look at this contango, that says the opposite. That says people actually feel better about, you know, modestly better. 21 is hardly a ticker tape parade for oil, but we feel better about, you know, December than we do about today. So which is true?
Yeah, so in Q, they believe that once, summer's passed, we're out of Q2, we go into Q3, there's going to be some demand that's going to pick up there. People are going to be more confident in going out, doing things. People will probably start flying and everything else again. And then in Q4, I think you get that pickup back in demand. And then obviously OPEC had made some supply cuts or some agreements to do things like that. I think that they've got to do more in order to get more of an equilibrium on prices and get prices going back up. I don't see, maybe $50 at the end of the year. That'd be pretty optimistic for these contracts. 40 is probably more likely, but if this carries on or we get a second phase of the virus and all of a sudden people are sheltered back in place again, we could be in this $20 to $30 range for the rest of the year.
Great to have your thoughts, Phillip. Appreciate it.
Yeah, thanks for having me.
Phillip Streible, Chief Market Strategist at Blue Line Futures. All right, we're talking to a trader. Up next, we're going to talk to a global market strategist with RBC. Michael Tran is with us right after this.